So SDXEnergy is an oil and gas exploration production company which was born out of the merger of two existing Canadian companies, Sea-Dragon Energy and Madison Petrogas, and that was in late 2015. The combination of those two companies was listed on AIM, renamed SDXEnergy, and it brought together a portfolio of assets in Egypt and Morocco, which was later completed by the acquisition of the Circle Oil assets in those two countries, taking advantage of the distress situation that Circle Oil was in at the time. Circle Oil was a publicly listed company as well in London. So SDXEnergy produces oil and gas from Egypt, two fields located on the western shore of the Gulf of Suez, and they also produce gas in northern Morocco. To give you an idea, production is about 5,000 barrels a day from the oil fields in Egypt, and it's about 6 million scf a day, which is about 1,000 barrels a day in Morocco. All the core assets are located onshore. So SDXEnergy is currently in a very good position. It has a stable base of production with some organic expansion opportunities. We can discuss that later. It generates positive free cash flow, and it has also a debt-free balance sheet. The strategy of the company is to stick to onshore assets. The oil production in Egypt comes from two mature fields, one of them having some expansion potential. Operating costs are low, some $7 to $9 per barrel, and the company generates a healthy margin even at those current oil prices. The associated gas business in Egypt is of low value to the company due to low realized gas prices of some $1 per MCF. However, management believes that the domestic industrial gas market can sustain prices of some $4 per MCF, and management believes that future gas opportunities could be very profitable indeed. The gas business in Morocco is very profitable due to gas prices of $8 to $10 per 1,000 scf, which are contracted to ceramics manufacturers in the Kenitra region, which is some tens of kilometers to the southwest. And we believe those higher gas prices are sustainable, given that the alternative, which is provided by bottled gas, is costing around $18 per 1,000 scf. And there is no other alternative, neither LNG threats in the medium term. Even if it could be imported, management believes that at current spot prices it wouldn't be a threat to those $8 to $10 per MCF prices. Yeah, so growth opportunities are threefold. First of all, are organic production expansion opportunities. Second are organic exploration and external opportunities. Third, through license or corporate acquisitions. On the organic production expansion that I touched upon earlier, management believes they can double their production and triple their reserves from one of the oil fields in Egypt, which is called Meseda. That could be achieved at a very low cost, about $3 million, through the implementation of a water flood scheme and some infill drilling, as well as a change of the downhole pumping mechanism in the producing wells, and also an expansion of the water treatment facility. So that's a very attractive project. On the organic exploration, there are opportunities in oil and gas, both in Egypt and Morocco. Actually, the company is currently drilling an exploration well, SD1X, in the South Dissouk license in the Nile Delta. They have already discovered gas in that well in the shallow objective, and they are now drilling ahead towards the deeper, potentially oil-bearing objective, which they should reach in a matter of days. On the external growth, SDXEnergy can take advantage of their position to acquire additional licenses, or even take advantage of the distress of some companies in Egypt that have been identified, and do some acquisitions as they have done with Circle. SDXEnergy is currently trading at 60p and change, which is about an enterprise value of $150 million. And that compares with a value of the producing asset, which has been independently assessed at around 130 to 140 million, and also a risk upside potential that we estimate to be about $380 million. Now, these might seem a bit high, but it takes into account the recent gas discovery in Egypt and also a risk value for the deeper oil potential. So we have updated that, and it's higher than the third-party assessment which was presented by the company pre the drilling of the SD1X, so pre-discovery of the gas, which could be around 250 BCF. So that's quite substantial. You can find more details in the report on that valuation. So at this stage, we believe that there's plenty of room and at least a 57% upside potential in the share.